Welcome back to Vantage. At a time of rising inflation, we really wanted to get someone in on the show who's looking at real assets. I've got a veteran investor in real estate. He invests in the UK and in Europe and directly. We're going to tackle, how that asset class is doing in the current environment, what he's looking at, and also address some of the things that we're all curious about. What's the future of working at home look like from his perspective? How's retail doing as a result of the pandemic? And has logistics run its course, or is there more to come through? Really looking forward to getting into the substance of that. Let's go and take a look. So welcome back to Vantage. It's a time of inflation, rising rates, and I thought it's a great time to talk about real assets, and very pleased to have Marcus Phayre-Mudge from the TR Property Investment Trust here talking about real estate. Welcome, Marcus.
Thank you, Neil. Good afternoon.
To start off with, and before we get into the fund and yourself, make us the case for why real estate as an asset class should be considered in the current environment.
Well, quite simply, you've hit the nail on the head. It is all about real assets, and it's all about, as far as we are concerned, finding physical assets and through the equity market where you're essentially going to see returns which are real. An awful lot of our income is index linked, so that's immediately providing you with that real earnings growth. But more importantly than that, we've lived in a world of really declining development. Believe it or not, we've actually had a less construction, not just through the pandemic, but really post the GFC more than a decade ago, which has meant there are a number of markets that we're invested in are severely undersupplied, and that's going to offer us proper rental growth.
Yeah, I can, as a former house building analyst focused on the UK, it completely resonates with me that. You have been looking at property a long time, bring us through the sort of career journey, the expertise of the property, and how you've come into your current role.
Well, I started my career in 1990 at Knight Frank and Rutley, as it was then, which just shows how old I am, as they dropped the Rutley 15 years ago. But essentially came in through the real estate industry, commercial property industry. And then in 97, I moved to Henderson Investors, that at the time was managing had in its stable TR Property Investment Trust. And I was really attracted to what was effectively a mixed mandate. At the time, it was kind of 70% equities, 30% physical property. But we've actually moved it much more into a greater percentage of equities, which we'll come on to later. And then in 2004, the previous fund manager and myself, Chris Turner, moved to Thames River Capital. And then from there, we subsequently, through various iterations, Thames was partially acquired by F&C, and then F&C was acquired by Bank of Montreal, and now Bank of Montreal's UK business has been acquired by Columbia Threadneedle. Yeah. But in all of that, we kept the team together. We're small. We're co-owners of the business, and in fact my CFO has been with me since '96. My head of physical real estate has been with me for over 15 years. Key members of the team, long time. The deputy fund manager joined me in 2009. So it's a long-standing, cohesive, coordinated team. In total, we run about 2.5 billion. Sterling, of which the investment trust is 1.5. So it's the mothership, as it were, but we have a number of other vehicles around it. Okay. So we're big players in a small pond.
Okay, and talk us through the investment trust in particular. You mentioned the size. Whereabouts does it invest? What types of assets does it invest in? Walk us through that.
Well, it's benchmark. So what we're trying to beat is essentially a basket of pan-European real estate equities. But the fund is able to invest in physical property in the UK up to about 15%. We currently have less than that. We're about sort of 6 or 7% at the moment. But the equity portfolio is very much split, roughly 50-55% Europe. Maybe at the moment probably a bit more, closer to 60 actually, and the rest in UK equities, and then this little slither of physical property. But we're very dynamic. We're able to move our positions, we don't have any geographical restriction. And then importantly, we run the currency in line with the benchmark.
Okay.
So what that effectively means is that if, say, I'm very underweight Switzerland, then we'll buy forward in the Swiss franc to equal the same weight as the benchmark. What that means is I don't have to focus on currency movements because I'm not generating alpha, positive or negative, from currency. So essentially, as an investor, you are buying a basket of currencies. That's the way you should look at it, which is broadly 55 euro, 35 sterling plus the physical property.
Okay, and we'll get into the sort of different sort of assets. So, Brexit has been a big focus for everyone over the last sort of 4 or 5 years. And given that you look at both Europe and the UK, from a relative value perspective, where is the value?
It's a great question, and the answer, unfortunately, isn't just about geography.
Yeah.
It's actually much more about subsectors of the market, and actually even drilling down into the city level.
Yeah.
So for example, during the pandemic, London and Paris suffered severely because nobody wanted to commute, and we saw very, very low levels of office occupancy. Meanwhile, in many other cities, particularly smaller ones, so for us, places where we've got lots of exposure, Oslo, Stockholm, Berlin, Munich, even Madrid, where you saw much higher levels of occupancy because people had shorter commutes, they weren't having to go on an underground, etc. So it's not necessarily a geographically focused. However, Brexit has impacted us in as much as we've certainly seen some multinationals look very closely at their UK footprint, and we have to very much factor that in.
From and I mean, I guess there's the impact side and the dynamics of that. I guess my follow-up to that is how much of that is actually priced into the market. So from a value perspective, what's the sense of that?
Yeah, I mean the growth v value argument will rage forever. Mm-hmm. We probably have a slight growth bias. I would prefer to buy companies where I can see that they're exposed to subsectors where rents are rising, there's development potential, and where basically they're well financed. So we remain long of, say, logistics markets, which we think is a huge structural tailwind, and we're still underweight retail. Now, we have been for a long time, but we are starting to see value in some retail sectors. But in terms of at a geographical level, actually, we've got parts of the UK market that are really coming back really quite quickly.
Okay. Quite interesting. And I think you started touching on this in your answer. So, as you're sort of allocating capital, there's certain drivers that you look for. But I'm trying to get under, what is your process, and then crucially, how you think that sort of adds alpha.
Well, the first starting point is that we do a huge amount of our own analysis. Mm-hmm. So the team, as I said, is 10 strong. We do buy research on the sell side, but mainly to see what they're telling other people as much as anything else. Without giving away all the secret sauce, but essentially we're trying to do as deep a dive as we can into the assets and the mentality of management. The great thing about real estate is a very small number of brains can run quite a huge amount of money. Yeah. And therefore it's actually crucial that we understand where management are focused, what they're looking for, where they can see the value add. Then we're overlaying onto that and our expectations of forward-looking returns just a couple of years, not that much further, because we find in the development cycle that once you get further out than that, it gets very difficult to analyze costs and land values, etc. So we're looking at that forward-looking 2-year price to today. Increasingly, though, we've been using, particularly in Europe, where NAVs are more flexible, the valuation community are more prone to not moving the numbers, as it were. then we're looking at cash flow much more closely and essentially earnings. And for the last, really post the GFC, what we've really found is that you want to find that CFO where he or she has really got the debt sorted out. And the great thing for the last 5 or 6 years is the bond markets have been incredibly attractive, and we've seen ever decreasing costs of debt. Now we are at an inflection point, which is something we'll talk about in a minute, I'm sure.
I think having someone who looks at real estate, clearly a question everyone is sort of grappling with, which is that you mentioned that London and Paris saw a more pronounced impact from the pandemic. What's your view in terms of, or is there a view in terms of different approaches to working from home in the different geographies? And is there a model, because I remember, people talking about the fact that actually rather than the sort of central office, there'd be hubs that you'd work in. Is there a model that you think we're sort of migrating to?
Yeah, I think that, nobody would be foolish enough to say that we're all going back to where we were. And therefore it is a hybrid approach. And that will suit a lot of people. And our experience in our team of 10 is that productivity does not drop at all. And in fact, allowing people to avoid what can be quite lengthy commutes, I as a manager get a lot more from the team. I think what we see as the key driver going forward is actually that people, in order to be persuaded to come back, and particularly in a war on talent, it's about the quality of the environment. Now, what we're tying that into is not only the quality of the working environment, but also the ESG criteria of the built environment. And we think we're probably at the early stages of a green building supercycle. So actually, and we're already seeing this, we've seen record rents paid in the West End for new buildings, new tenants going into new space, record rents paid, in this quarter. And that's quite simply because there is a serious shortage of best in class. And if you are a FTSE 100 or a Fortune 500 company and you've told your shareholders that you're going to be carbon neutral by 2050 or 2040 or 2030, the building that you occupy has also got to fit that criteria. So we're going to see a huge growth in that side.
So there's this upgrade cycle that you're expecting to see.
Absolutely. And it won't be new build. A lot of it will be basically refurbishment. A bit like buying second-hand vintage clothing, pre-loved. You want your pre-loved building, but you can then retrofit it. And then what you then look at is, you look at people who have a track record of doing this. So in the UK, that's Great Portland Estate, Derwent London, Helical Bar. On the continent, we have, Arima in Madrid. We've got various of VIB Vermögen in Germany who've just got a talent for basically pulling these buildings forward.
Okay, perfect. You touched earlier on retail and the fact that you thought that you're starting to see it recover. I mean, it's one of those, it's been a falling knife, yet it sounds like you're ready to catch it. Is it too early, or what are the signs of recovery there?
This is where there is a very strict difference between the UK and the continent.
Okay.
So the UK, we always had shopping centres that were anchored by department stores. In Europe, your shopping centres were anchored by hypermarkets. Remember from your camping holidays in France, big food place next door to your shopping centre. Of course, the department store is no longer a format that works. And that's a real problem for the UK. On top of that, the UK, we were very early adopters with online retailing. So for example, we're at close to 30% for all retail non-food. Italy's still sub 5. So Italians are still going to shopping centres. They're not necessarily waiting for the man in a van to deliver stuff. So you've got these big differences. So we see Europe coming out of this faster. Of course, Amazon are busy building all over Europe. They're not, they're just, to an extent, it's a more slowly melting ice cube. But rents have always been much more affordable on the continent rather than the UK. So in summary, we're getting back into Europe in a big way. UK is still quite cautious, although we have started buying into retail warehousing. And quite simply, that's just about the fact, if you think about the click and collect phenomena, you're very happy on a Saturday morning to pop down to Pets at Home and collect your food. What you don't want to have to do is drive all the way to a big shopping centre, park, traipse miles, carry all of this heavy stuff back to the car. So where it's convenient, you'll do it. The retailers are very keen for us to do click and collect because actually it's the last mile delivery is the expensive part for them. And also when you click and collect, you go and pin to the store, chances are you'll buy something else as well.
Yeah, it's a nice segue to the next thing I was looking for. So you're still invested in logistics, and of course, e-commerce has been a big driver around that logistics as well. Still staying in it. What are the sort of 4 drivers if you look forward in terms of?
Yeah, we've certainly rotated our thinking. We were very early into this, and we saw tremendous yield compression. Yields are now down, getting close in many markets to what we see as a sort of floor, as it were. They can't fall much further. So values on standing assets can't necessarily rise. 2 things will happen. One, rental growth will continue to come through. So you will see value appreciation. But where we think the real sort of gold mine remains is in development and is in land. And we have lots of exposure in Europe through a range of small companies, actually, which are now very hard to get access to, in terms of the pricing of the shares. So we're very much in those developers rather than in the standing investors. And in fact, there's a very live situation going on in Germany, where my stock company I own called VIB Vermögen, where another company has made an approach, and we've had a 15% share price movement in the last 5 weeks. So it's, there's lots of activity in the space. Yeah.
One of the things we're seeing is, probably in light of the volatility we've seen in the market, there is a growing appetite for non-correlated assets. For someone looking at sort of the real estate sector, what are the new areas for alternative property that you see?
Well, this has been the big difference between the performance of TR Property Investment Trust and, say, a bog standard open-ended property fund, which has traditionally been sort of retail, mainly retail and offices, and might have a little bit of industrial. The great thing for us is we've been able to get into all those alternative sectors, and the ones that we think are still very valid, albeit we're waiting for new, potentially lower entry points on volatility, self-storage, student accommodation. Healthcare is really interesting, but there are lots of different bits to it. You have to be very careful. So we actually prefer at the moment primary healthcare, where you've got a direct relationship with the NHS or the European equivalent, rather than, say, nursing homes where things are quite tricky. The moment operators are not, their margins are very thin. And then, of course, you've got sheltered housing, etc., social housing. Some of those are quite interesting areas as well. We think that co-living is going to become a bigger thing. A lot of themes that you see in the US eventually find their way over here. And certainly that multifamily work-live model is quite an interesting one, and we expect to see that grow.
Okay, interesting. The boom in sort of refurbishment in terms of ESG compliance is something you touched on. I'm clear for, if I was looking at a traditional equities fund, I know how a manager might go and look at a company from an ESG perspective. How's that work on a real estate company?
Yeah, it's really, really interesting. It's very much a key question. I think if you was to split the ES and the G, we're all over the governance because we're a big fish in a small pond where you have a lot of engagement with a lot of companies to make sure they're doing things the right way. That from a social point of view, we are, real estate is creating an environment in which we all live, work and play. And that's actually, we tick a lot of boxes there. The key one is the E. Clearly, you can't, at the moment, 99% of all buildings are still built using concrete and steel. And so for us, it's making sure 2 things. One, that we are working hard with companies and encouraging them to use other materials. But when we're looking at whether a company is one that we wish to invest in, it's unreasonable to say, well, here you've got a logistics company where their entire portfolio has been built in the last 10 years, brand new sheds with wonderful photovoltaic cells on the roof, etc., etc. And here we have a German residential business where all the apartments were built after the Second World War and all require a lot of energy improvement. So our view is that wherever people are starting from, we want to find a base metric which we then make sure they're all improving from that base. But essentially, one is going to start much higher than the other. Doesn't mean you discount this one, but you just make sure that they're constantly improving. And that's the message that we've sent to all our companies. And we're constantly updating the measurement that we're using.
It's clearly a sort of thing that's transitioning, and everyone is adopting and learning how best to deliver on ESG. And of course, every year you hear people discuss it, set out new sort of guidelines, and we're all learning effectively to move towards that. Let me wrap up by sort of bringing in a little bit of human interest. So I always want to sort of, I think having done the role, I think we're all fortunate in terms of, we've been doing these roles for a number of years. There's wisdom that you sort of pick up through that. And my question to you is that if you look back at your career, what's the one thing that sort of surprised you, either in a positive or negative way, through that journey?
I think the surprise has been the returns actually that we've seen. I mean, what is not a particularly sexy asset class.
Yeah.
The investment trust's total return over the last 10 years has been 15% per annum, and over 20 years has been 14% per annum. Mm-hmm. Now, I know that back in 2000 we're just after the dot-com boom, and I know 10 years ago we were just after the GFC. But even so, those numbers are pretty impressive, and I suppose I'm been really pleased that we've managed to deliver alpha ahead of our benchmark in almost every year. Yeah. Over that time. And then the final one is that I'd probably be a bit surprised that I'd have maintained, not diversified my own personal investment exposure. I've just kept buying my shares in TR Props. Yeah. And in fact, the other day, my wife did say, why are the children's junior ISAs also in TR Property? I said, well, you've got to eat your own lunch, really. But yeah, and I suppose the real surprise is how much I enjoy it. Yeah, which is might come as a surprise.
Is there a favourite building? Something that you think you?
Oh gosh, that's a really, really tricky one. There was a building which we had on the front cover of the annual report last year, which is a building in Rotterdam by a Dutch architect, and it really does. It's a fully utilised building, but it does genuinely look like a ship. Yeah. And I always admire architects. I always find fantastic architecture is admirable, and to be able to create something that just looked so fantastic, but resonated with its local environment, but was also a great piece of real estate, was I think is a real skill. And if I could be born with again with a skill, it would be that architectural, that eye. Yeah. So all I can do is find the good ones and follow them.
Thank you, Marcus. It's been a pleasure having you on Vantage. I think it's great to get an expert's view, particularly the timing is perfect. We're looking at rising inflation, real assets, clearly coming into focus. There's a lot of people thinking about how do I get exposure to that. I think what you've sort of characterized to us is a team that is stuck together for a long period of time, that brings a lot of expertise, that does a lot of its own groundwork effectively to get comfort around what it's investing in, and has the flexibility to go into sort of interesting areas to provide the returns. And when you articulated your 10-year returns, and of course we all know that past returns are not a guarantee of what is to come, but I think it provides a real sort of window of an asset class which is at surface potentially very boring, but can generate actually some really interesting returns. Thank you very much for coming on the show.
Thank you, Neil.